Welcome to We Chat Divorce, hosted by Karen Shalhoub, Legal Liaison, and Catherine Shanahan, CDFA. Each episode, we sit down with divorce professionals and industry experts to provide insights and frank discussions about real people, real situations, and real divorce to help you achieve your best life post-divorce. This episode of We Chat Divorce is brought to you by My Divorce Solution, offering divorce financial planning so clients can secure the divorce settlement they deserve. Visit mydivorcesolution.com to request access.
If you remember one thing from today's episode, let it be this. The most expensive divorce mistake is usually not legal. It's moving toward an agreement before your financial picture is complete, verified, and understood. Here's how it shows up in real life. Someone is exhausted. They want relief. They agree to keep the house because it feels stable, or they accept an account summary because it's close enough, or that's what they're told. Then the dust settles, and the agreement that looked fair on paper stops working in real life. Today, we're going to talk about what divorce financial clarity actually means, what a verified financial picture includes, and what you should have in hand before you sign anything. This is Divorce Explored, a series within the We Chat Divorce podcast. I'm Karen Shalhoub, Legal Liaison and co-founder of My Divorce Solution. Before we dive in, today's boundary, we're not giving legal advice as usual. We're staying in the financial lane. What your numbers mean for your real life, not legal strategy or court outcomes. I'm joined today by my co-founder, Catherine Shanahan, CDFA and Divorce Financial Specialist. Catherine, can you set the stage for us in our discussion today? Where does financial clarity fit into the divorce process?
That's a great question, and actually a very important one, because a lot of people have a lot of different opinions about that. But clarity, first of all, is not a feeling. It's not, I think we'll be okay, or your spouse telling you that everything will be okay. It's really having reliable answers that you can support with documentation. You know, numbers look great on paper, right? And it looks fair when things are divided on a spreadsheet 50-50. But those numbers don't show all the details to an account. It doesn't show what the impact will be to you, whether it's a taxable investment, a tax-free investment, or if it's an investment that has a huge cost basis that you'll end up paying taxes at some point that you were not aware of. So clarity also means knowing what you have and what you don't have. You know, a lot of times we have individuals come through the process that decide to just put a lump sum amount of money that they want, and they don't care where it comes from, but that's what they want because they're not getting all the documentation, so they throw out a number that they think. Maybe that is your clarity if it's just a number, but not many people can do that. So for us, it's about getting that documentation and verifying the numbers and understanding what the impact of all the details in those accounts actually mean to you post-divorce.
Exactly, and that is really what today is about, the inputs. So let's start at the beginning. What does divorce financial clarity actually mean? Let's define it in a way that's useful, not a buzzword. It's not a feeling. Divorce financial clarity means having reliable answers about your financial situation that you can support with documentation, or that you can support with, I know I don't have the documentation, but I know that this is a good financial option for me. It's the difference between negotiating from facts versus negotiating from assumptions. At My Divorce Solution, we use a concept called the financial clarity gap. It describes the distance between what feels manageable in the moment, the relief of wanting it done, and what you actually need long-term: income stability, a settlement that reflects real numbers, and an agreement that holds up in year 2 and year 5, and not just on signing day. Catherine, we see this pattern so often. So let's talk about, what does it look like when someone comes to us mid-process without that clarity? We see it every day.
Yeah, because clients who negotiate around summaries instead of the source of the documents They're dividing balances without understanding what those numbers really mean, especially after taxes. I talk about one example where, there's $1 million in Apple stock, and husband wants wife to keep that account because he wants to keep the property. And it looks equal. But what she didn't realize is that $1 million had a very large cost basis, meaning that she'd owe over $100,000 in taxes if she liquidated any of that money or liquidated any of those stocks. So you really have to look at what the assets are in any brokerage account that you're keeping, because you don't want to be surprised later when you're hit with a tax bill. And relief is a powerful emotion. Everybody wants to say, oh my gosh, it's over. I got there. Here I am. I feel so relieved. But what that does in a lot of cases is it makes rushed decisions. You're just making a decision to get it over with. So what I like about our process is that we try to slow you down, not to create any conflict, but to create the financial clarity that you need before you make decisions. I always say, if you give away too much and you want to give it back, we'll help you give it back, but nobody ever does that, right? So get the clarity you need before you sign off. And that's going to be your best relief in the whole process. Because actually, Karen, we always see it all the time. When you have that financial clarity, it actually reduces conflict. Yes, one party might get impatient and they're trying to rush you. But if you're making these decisions based on clarity, you're not so, I don't want to say judgmental, but you're not so eager to blame the other party for financial mistakes, because you're making these decisions based on your own clarity, not somebody else pushing an agenda onto you.
And how often, Catherine, do we see the rush where people need the relief and they're in panic? And it happens all the time. They believe that a mediation's coming up, or pretrial is coming up, or even trial is coming up. And somehow they believe with all their heart that someone's going to give them that clarity ahead of time. And then we get the call a week or 2 weeks or 3 weeks before a mediation or a settlement conference. And the client realizes that no one's going to give that to them. There's no attorney meeting on the calendar and nothing is going on. And so then they're in full-on panic mode about, I'm not clear, and what can I do? Can we just talk about that a little bit?
Well, let me share a story about the assessment the other day. I don't even know if I shared the story with you yet. An assessment, immediately I read the notes that she writes into our portal, and she gives a long description of how she's feeling rushed into pre-trial conference first week in April. And, for me, I start off, I don't know why I'm taking the call, but I'm taking the call. And I start off by saying, okay, we need to talk about what you need, because this turnaround, I don't know if you're going to qualify to be our client, or not that you don't qualify, but I don't know that we have time for you to be our client. Let me find out what's happening here. Long story short, this pretrial conference can't be postponed, but she doesn't have to make decisions that day, is my point here. But anyway, she goes on to tell me some stories, and we go through her assets. I verify from the assessment that she took, and the parties sold their marital home already, and they split the assets. So now, what I'm saying, we never agree to that. We sell the home if you have to sell the home, but that money should be held in escrow. Yes, each party can take a little bit to cover any costs that they have for immediate expenses, but the majority should always be held in escrow, because that's a leverage for negotiation. She is in an equitable distribution state, so it's not necessarily 50-50 with the division of assets and debts. So she had a gut feeling about that, but her attorney was like, no, this is good. This way we split the money. And now when she circled back to talk about it, she goes, well, no, that asset was already taken care of. We don't need to discuss it anymore. So she's upset about that. We continue the conversation, and they have restricted stock units. Okay. Yeah, but this is what my husband does. When they are available, when they invested and available to be distributed, we do that. And he said to me, would you like me to sell your half of the shares? And she's thinking, well, yeah, because I need money right now. He goes, okay, but I don't want to sell them. So I'll just give you a little bit more out of another account, and I'll keep the shares. So now The divorce is not final. They haven't negotiated anything. I said, did you put that in writing? She said, no, but he did give me some cash. I said, okay, well, we'll want to just discuss that with your attorney, because he held on to those shares because they're worth a lot more today. But she didn't even understand what the value of the shares were, if they were good shares or not. They never discussed the stock options during their marriage and didn't realize the impact of making that decision today. Now, I don't know if she'll have a reimbursement claim or not, and I don't know if that could just be considered a partial advance to equitable distribution. And this is where we will consult with her attorney to get the legal ramification for all of that. But I become a little frustrated having these conversations for the client that we're speaking to, because it infuriates me that parties are taking advantage in a very vulnerable spot in their lives. And I get why she made that decision. It's no judgment on her, other than she thought, how am I paying all my fees? How am I moving into a new apartment? How am I doing all that? Oh, here's an option. I can get this cash and it's so easy, and he's just going to hand me this money. And meanwhile, it could be tens of thousands of dollars of a mistake for her.
Absolutely. And, it could be not even adversarial on his part. Maybe neither one of them know if he's been the financial manager. He's just doing what he always does. I think so many people don't understand that once you hit the divorce arena, everything you knew about net worth statement and cash flows changes on a dime. And I think that's where the confusion comes in. And that's why financial clarity is so important. So the last point that, you just said, Catherine, is important. Clarity isn't adversarial. It's actually what makes resolution possible. So, just take the situation that you just spoke about. Some of that clarifying could create conflict because it wasn't discussed in the moment when the transactions were being had. So there could be a lot of confusion created already in that dynamic that it absolutely needs to be cleaned up, but it needs to be cleaned up with intention. So here's the trap that most people fall into. They negotiate around summaries instead of source documents. They accept numbers that haven't been verified or clarified, or people understanding what the financial impact is, and they divide balances without understanding what those balances actually mean. Catherine's point, after taxes, after fees, after real life cash flow, which brings us to the question we get asked constantly. Well, what does a verified picture actually look like? Let's talk about that. A verified financial picture has 4 pillars, as we say. Let's go through each one. And Catherine, I'll pull you into each of these because this is your expertise here today. So pillar 1, the full scope, not just the accounts that are easy to find, but the complete marital estate, every asset and every liability. And we often hear, well, that's a separate account, or well, that's an inherited account. Disclosure is so important. We can't tell you how often people reach a settlement and discover something significant was missed or overlooked or not included. So, Catherine, what do people most commonly leave out?
So some common omissions. The first one I'm thinking of is actually from someone yesterday, is getting the right pay statements, right? So they're saying, oh, I have a March pay statement or a January pay statement. If you can only get one pay statement, you want to get that year-end pay statement and not just the W-2. That's the other common mistake. People will say, oh, I have the W-2. I have the W-2. Okay, but that leaves out some really important information. So you also want that year-end pay statement. Deferred compensation. There's stock options. Some are vested, some are not vested. When were they granted? Are they marital? Are they non-marital? Is it a portion of the vest date? Some take a portion, some take totally when they vest, some take when they're granted. So these are important things. Pension valuations. That's always a interesting one because some people are already in pay status. They're receiving their pension, but it was an asset. So does it get divided as an asset, or does it get included as income available for support? Something that really needs to be discussed and determined before you just agree that someone's keeping a pension or you don't want a pension, right? You don't want your spouse's pension. I hear that a lot. Oh, I would never take my spouse's pension. I didn't work for the company. My spouse told me I could not receive it. Well, that's not necessarily the case. So you do want to find that out. It's a big asset you could be leaving on the table. Some other ones are business interests. You get K-1s for your tax reporting and for your tax return. Does it mean you own a company, or do you just have an interest in the company? Two very important differences, because there are a lot of documents that we need to verify that information. Again, it could be a lot of money you're leaving on the table, or maybe not. Maybe there's debt associated with some of those assets that you don't want to be a part of, but you should have clarity on what it is. Retirement accounts. A lot of people overlook loans that are on their 401ks. You don't want to do a quadro, a qualified domestic relations order, and not know if you should include the loan or not include the loan on the value. Again, it can make a big difference in your division of assets. Another big one is debts. I mean, I could go on and on forever. Debts that you weren't aware of. You get a credit report and all of a sudden you see debts that you had no idea that you had before. Who's responsible for that? Probably you. It's probably a marital debt. So again, it's something that you need to be clear on before you sign off. And you don't want to find that information out post-divorce, that you forgot to cover that. Or you wish you would have covered that. I hear that a lot, right? So the full scope isn't always about what you know about. It could be that of what you don't know about, but you should be clear about. And again, that's the whole point of our conversation today, is getting that financial clarity.
Yeah. So pillar 2 is what's it really worth? Once you have the assets identified or debts identified, what's the value assigned to them? Not just what the statement says, but what the asset means to you after taxes, liquidity constraints and risk, and even third parties that may be attached to those assets or debts somehow. So Catherine, this is where a lot of agreements look equal on paper, but quietly become very unequal in real life.
Mm-hmm. I'll give you the biggest example and the biggest overlook by a lot of people, and that is a Roth IRA versus a traditional IRA. Now everyone sees the IRA and they think it's the same. They don't understand that a Roth, or they're not clear that a Roth the taxes have already been paid on that account. So that's a tax-free account. The traditional IRA, the money that you put in or rolled over has been taxed, but the growth on that IRA has not been taxed. It's been tax deferred. They're both very good assets, but a Roth IRA probably is the better asset because it doesn't have the tax impact that the traditional has. So I see a lot of times when I see a spouse's proposal and always the Roth is in their column. Oh, you can have the other one, or you can have, of course they say that. So you just want to be clear on what you're actually giving up there.
Okay, let's move on to pillar 3. What life actually costs post-divorce? One household becoming 2. The monthly math changes structurally. Catherine, what happens when people skip this step by retaining assets that they may be more emotionally attached to, but don't understand the cash flow that would be needed to keep those?
The big one is the house, right? So, you have to do your income and expenses for most states for your financial affidavit. And a lot of times it's completed based on how you're currently living, what your lifestyle is. And then sometimes throughout the process, you move or you're paying rent and you're not paying mortgage. So maybe your income and expenses change, or maybe they don't. You keep the house and you think that's what it is. But typically you don't get a spousal support number, and all the states are changing to really meet your total needs. But you're thinking, oh, I can make that happen, or yes, I'll get a job and I'll do that. But then you stick with that house and you quickly realize the maintenance on that house is more than you expected. Or you thought you would cut back on whoever mows your lawn, or whoever takes care of your pool. You think that you're going to do that yourself now. Or worse yet, I've heard spouses say, no, I'll come back and help you take care of that. And guess what? They don't really come back. And if they do, not for very long, to help you take care of that. So you're stuck with this. And now your cash flow is something you can't keep up with. So you're forced to sell the home. Or this is just one example. And now you're selling the home, and you may only have the single person exclusion on the home because you waited 3 years or 4 years to sell the home. And you gave up a retirement asset, and now you're 55 or 65 and you realize oh my gosh, I don't have any money in retirement for myself because I spent it taking care of a home that I kept. So you really have to kind of remove yourself from your current life. Think what your cash flow will be, and when you get get a realistic support number that you may be getting and for how long, so that you don't want like this pie in the sky number that people throw out at you. Get the realistic number so that you can understand what your cash flow might truly look like. And then you decide, do I really want to keep this home? Do I really want to negotiate away our retirement? So many people get into that trap of keeping the marital home.
They do. And what we see a lot of is when there's a family business that skews the cash flow, where the family business is taking on so much of the household expenses. And when you add them back in and put them where they belong on the, lifestyle analysis, that can really get skewed. And then, if you don't go through that exercise, you have no idea what those numbers could be that could just add to the challenge that you just talked about, Catherine.
Karen, I'm so glad you brought that up, because that's another promise that spouses who retain the business make to their soon-to-be ex-spouse. Don't worry, I will continue to pay for our kids' cell phones through the business, and I promise to pay yours as well, or I'll keep you on the insurance for X amount of months, or I'll still handle the maintenance on the home through the business like we've always done. If that is not in writing, that is not going to continue like they're promising. And if it does continue, it will probably only continue for a limited time. So if they're saying that, and if you believe that to be true, I would have it in your final agreement written legally. And if you do not take that step because you do want to trust your spouse and you believe you two are amicable, I would still calculate realistically, if that spouse were to stop paying that, what would my cash flow be? And is it still to my benefit to keep whatever asset I'm keeping, if that would change? Because again, I don't want to sit with you at lunch 5 years from now and you say, shit, Catherine, somebody should have told me that he would stop doing that or she would stop doing that, because I would have never negotiated away something else. So again, just know the negative side to it. I always like to know the pros and cons. That to me is what financial clarity is, knowing the pros and cons of everything, right? So it's know what the con is, and then would you still make that same financial decision on the other side of something?
Yeah, because if those household expenses or personal expenses are paid out of the business, and then they're added back into the value of the business, your spouse may do a complete 180, because essentially it could be some form of double dipping in their mind. Why am I going to add this back to the value of the business and pay for these expenses? And then how are you then going to recover back out of that? So that's perfect. Like, you should know how the courts look at it, and then you and your spouse can make really good decisions knowing the financial impact and what your options are.
And ask questions. The spouse might say, oh yeah, I wanted to do that, but my accountant told me I couldn't do that any longer.
Mm-hmm.
Right? So now they don't look bad, and maybe it is true. It probably is true, because most businesses take too many deductions that they shouldn't be taking. So yeah, it could be true. But if that happens, what is the effect to you? Like, what's your impact? So you want to have that discussion. If you stop paying those things through the business, how will you compensate me for that moving forward?
Yeah. And if you don't, what will we do? Like, if someone passes, if someone gets another partner, if the business folds, like anything could happen, right?
Mm-hmm. Well, we're really great over here for asking questions. Again, I'm going to say ask, especially if you say you're going to be amicable. Those are my favorite. Okay, good. If you're going to be amicable, then you can ask as many questions as you want, because asking questions is not questioning somebody's integrity at all. It is asking questions so that you have the answers to make really smart decisions. And if the person on the other side who you're asking questions to gets agitated or refuses to answer them, then they're not really being amicable. Just remember that. It's okay to ask questions to get the clarity that you need.
That leads us right into pillar 4, the long-term consequences. Not just who gets what, but what does each choice do to the next 5 years, 10 years, 20 years? This is where scenario modeling comes in, and it's probably the most underused tool in divorce financial planning. Catherine, let's just talk about some quick examples of how two settlements that look similar can produce very different outcomes.
Well, I don't want to be redundant. I think I've talked about a lot of them today. For example, the Roth IRA and the traditional IRA, they look equal today, but fast forward 20 years, your traditional IRA grew tax deferred, your Roth IRA grew tax free. So if your spouse kept the Roth and they did a liquidation, they're not paying taxes on it. If you took the traditional and you took income from that, or you took your asset out, it's taxable. So it was not really equal at the end of the day. All of these, it's the same thing. That example also I gave earlier. You kept a brokerage account that was heavily invested into one stock or two stocks or however many stocks. Your spouse kept a cash account or the home, and the tax consequences to those two assets over time are very different. So you're left stuck with a taxable burden where your spouse may not be stuck with that same taxable burden because it was a different asset. So you really just have to go through different settlement scenarios so that you can see the trade-offs you're making before you commit. A big saying is model it before you promise it, right? The best agreements are functional. They're not just fair sounding or fair looking on a spreadsheet.
So those are the 4 pillars: full scope, true value, real post-divorce cost, and long-term impact. That's what a verified financial picture includes, and that's what we build through the MDS Financial Portrait. Document verified, modeled, and organized so clients and their legal teams can negotiate from facts and documents that you have, and a clear understanding of documents that you may not have, that it's important that you get or that you can offset for the lack of documentation. So coming up next, we're going to have episode 2 of What is Divorce Financial Clarity. And we'll talk about why even amicable divorces can get financially expensive and where people most often get trapped. So stay tuned, look for episode 2, and we'll see you on the next Divorce Explored. We Chat Divorce.
Thanks for joining us on another episode of We Chat Divorce. We hope this episode was informative and supportive on your divorce journey. If you're looking for more support for navigating divorce with confidence and clarity, head over to mydivorcesolution.com for more podcast episodes, divorce events, and resources for your divorce. We'll see you back here for our next episode.